Hey guys, it's your weekly dose of Make Money Count. Today we have the privilege of having Marcus in the studio with us, which is really exciting. How's your day?
Great.
Good.
Yeah, great. How's yours?
Who's all right?
Oh, yeah, you're having a tough morning.
No, yeah, but also some inconvenient things happened to me, such as I forgot my work pants. Work pants just being dress pants. And then when I went to get soap out of the soap dispenser today, it shot past my hand and onto my pants. So I had to take a mini shower out of the sink.
What, are those Lululemon tights?
No, they're just jeans. They're very comfortable.
They don't look comfortable.
They are very comfortable.
Really?
Yeah.
They're just so tight.
Your jeans are tight too, but
Are they? I guess they are. I mean,
yeah.
they don't seem nearly as tight looking at those things.
Definitely not. They're not.
I feel like those jeans, if they could talk, they'd be saying,
They make me feel pretty, and that's all that matters.
you know what? Actually, they're pretty aptly worn today because we're going to talk about Fed tightening.
Okay.
Like
I love it.
The Federal Reserve tightening.
Maybe that's why I
rates.
wore them.
For sure.
Yeah.
But you know what? The only thing tightening more than those jeans is the Federal Reserve.
Okay. Hey, everybody. Hit the like button. Hit the subscribe button. Leave a comment. We'll talk about it in the next podcast.
Be sure to visit MakeMoneyCount.com to find all of our old episodes.
So tell us about it. What's happening?
So the Federal Reserve kicks off a 2-day meeting today.
Okay.
Tuesday, the 20th of September today.
That is today, yeah.
And then tomorrow they're going to announce what is widely expected to be a 75 basis point rate hike.
Okay.
Which I think we can then expect the Bank of Canada to follow suit with another 75 basis point rate hike. The interesting thing that we're seeing now is there is increasing dissension among big business leaders and economists. Elon Musk recently tweeted out calling for the Fed to decrease interest rates.
Right. Yeah, people are getting upset.
So maybe the mechanisms that the Federal Reserve utilizes to assess inflation and inflationary pressures on the market aren't as current and responsive as what is required to actually judge what's going on in the real economy.
Right.
So there's a whole bunch of people that are coming out saying that the Federal Reserve is going too far, right? There's Elon Musk. There is a guy named Jeff Gundlach, who is they call him the bond king. Like runs a multi-billion-dollar bond fund called Double Line.
Is he also a member of the NRA?
I don't know. He lives in LA.
And his last name's Gundlach.
No, I don't think he's I don't think he's a gun guy.
Just for the reference, you were supposed to laugh. But continue.
Okay. Those are the best jokes. Those are the best jokes when you have to be like,
yeah. This is where you laugh.
yeah. So, Elon Musk, Jeff Gundlach, a guy named Barry Sternlicht, who is the guy that kind of amalgamated all of the Starwood resorts.
Okay.
A lot of hotels.
Mm-hmm.
Kathy Wood, very famous investor with a fund called ARK Investments, which has just got hammered, invested in a lot of tech stuff and really got hammered. Anyways, and I'm sure that there's a whole host of others, have all come out and said that the Fed's going too far and that they see deflationary pressures on the horizon for the economy.
Right.
If you remember when we started these kind of podcasts addressing how people are going to deal with the interest rate shocks that are coming, we were saying that it's very hard to target inflation to the degree that the Federal Reserve intends on targeting it and end up with a quote unquote soft landing for the economy.
Right.
At the beginning, the Federal Reserve and the Bank of Canada were issuing these press releases, and in their reports, they were saying things like, the economy is going to have a soft landing. We have no concerns over creating a recession. And then the verbiage changed to, this will be a difficult course of action, but if we do it properly, we will have a soft landing. And then we heard things like, it's like threading a needle. Like the kind of probability of a soft landing continues to diminish as the Federal Reserve and the Bank of Canada and frankly, all the central banks around the world communicate to investors and the general public, whoever is willing to listen. So I think now, with the consecutive jumbo rate hikes that we've seen from multiple central banks around the world, I think now more and more investor sentiment is that we're not going to see a soft landing.
Right.
I think it starts off now with these few contrarian views that we're talking about, that deflation's actually starting to take hold, and that further rate hikes by the central banks will only exacerbate the problems of the economy in the future.
Right. And do you believe that? Like, do
Yes.
you believe
Yeah,
that?
I very firmly believe it. Like, I think that these successive jumbo rate hikes are going to serve the purpose of, eliminating this inflationary pressure. But I think that a lot of, if you look at some of the kind of commodity prices that we track, a lot of them have already decreased year over year, right? The exception of oil, and oil's come down, natural gas, some agricultural items, and a lot of that might be as a result of the war in the Ukraine. But I think that on an overall level, the consumer is going away, and we're seeing it already. Another big thing that came out last week was the CEO of FedEx came out and said that he sees a massive slowing in commerce, and he sees a global recession imminent, an imminent global recession. So, I mean, you've got some of the richest, most powerful people with what you could argue is kind of the people who are closest to having a pulse on the economy, all saying that we're going into a very difficult economic time, and it will only be worse as the Federal Reserve and the central banks in the world continue to hike interest rates.
Right.
So I was worried when we first started talking about this, because the Federal Reserve and the central banks around the world have been so clear that they are increasing interest rates to fight inflation.
Right.
And that they are not going to stop. And it almost seems as though the stock markets, let's just say the stock market, and encompass like the S&P, the NASDAQ, the Dow, the TSX, let's encompass all of them into one and call it the stock market. The stock market's playing like a game of chicken with the Fed. Stock markets are always kind of known to be overly optimistic. And that's why you see whenever the Federal Reserve intimates that, no, we're holding course, we're going to keep increasing interest rates, the stock markets get hammered.
Right.
And whenever a bad piece of economic data comes out, the markets spike, because they're spiking on the hopes that the Federal Reserve will slow down the pace of increasing interest rates in light of the new data that's come forward.
Right.
But I think that this massive monetary policy ship that is being guided by the heads of these central banks is on course to continue to increase interest rates. And there's very little data that can come in right now, perhaps short of successive month-over-month drops in that kind of those CPI numbers or inflationary measures. There's very, very little that can happen other than a decrease in those numbers that will cause them to take pause. And market's already baked in 75 basis points right now. So it's not going to shock it heavily. But the verbiage that comes out of this next meeting will shock it heavily.
Right.
So, I mean, listen, people are listening and watching this podcast, and their main concerns are either like, what am I going to do with my mortgage rate?
Mhm.
What am I going to do if I need to borrow more money?
Mhm.
And should I buy a piece of property? Someone phoned me on my way here today, and they're looking to get a pre-approval.
Right.
I said, hold on. I said,
Yeah.
no problem. Get a pre-approval. It's not a bad idea. But like bond yields right now are at the highest they have been in 15 years. Like the 2-year US government bond yield is at its highest level in 15 years.
Right.
And that is, that's telling us that, these short-term rates are going to be high.
Right.
And, the impact of these relatively extremely high interest rates still has not been felt in the market.
Right.
Like if you think about it fundamentally, if you are a household and every day your cost of owning that home is increasing,
Mhm.
the cost of the goods and services that you consume are increasing, and your income is static, like I can't imagine the amount of anxiety on the average Canadian household um, on a day-to-day basis right now.
Right.
And it is not abating, right? Like, what are we being told? We're being told that interest rates are going to keep rising. So what happens, I think, is, and let's peg this one, okay, Matt? Like, let's revisit this. I think we're already going to start to see the signs of deflation. Okay. I think that, and deflation's scary for kind of deflation almost creates a similar effect as inflation in that consumers don't spend in a deflationary environment because they're kind of constantly thinking like, oh, well, prices are going to go lower. So the consumers don't spend in an inflationary environment because things are too expensive and they don't have enough money to spend.
Mm-hmm.
They also don't spend in a deflationary environment because they think that things are going to get cheaper.
Right.
So it equally seizes up the economy. On top of that, you've got rising unemployment in that environment. You've got falling asset prices, and you've got a heavy recession.
Right. You say that we'll start to see signs of deflationary, of deflation. And what are those signs? Like, what do you think will happen first? Like, what's the first thing we'll see?
Listen, people feel poorer as their asset prices drop.
Mm-hmm.
As asset prices drop and the cost to service debt loads continues to increase, people sell those assets, right? That's what stimulates this drop in asset prices.
Mm-hmm.
And if supply and demand, right? If too many assets are for sale and there are not enough people willing to buy those assets, those prices will continue to fall.
Right.
So like look at real estate.
Yeah.
Well, the kind of initial impetus for real estate to drop has been introduced into the market. But real estate doesn't transact that quickly, right? You kind of want to hold on to your real estate,
Mm-hmm.
right? So people will hold on as long as they can. Interest rates will continue to increase. And then people will sell that real estate. Will there be buyers available for that real estate? Only
Right.
at a certain point when the market understands that real estate is really, really well priced.
Mm-hmm.
More so, only when the market understands that interest rates have either reached a bottom or reached a top and are looking to reduce.
Mm-hmm.
At that point, support comes in for those assets and ideally creates a floor, and then those assets will kind of will start rising again.
Right.
In order to re-stimulate the economy.
Right.
I think that what we'll see is, I think we're going to see another 75 basis points, right? I think that's priced in. Everyone agrees to it.
Right.
I think we might even see, depending on how quickly the data kind of filters through to the Federal Reserve, might even see another 50 basis points after that. And then I think that the verbiage in that meeting and the way that consumers responding at that point, I think that's when we'll start seeing a more dramatic, a more pronounced impact on the general economy.
Mhm.
At which point, the Fed pivots, the central banks pivot.
Right.
Maybe because of maybe it's pressure from the politicians. Listen, nobody wants to be in charge of a
During this
country
time.
when everything is looking gloomy.
Right.
Right. We spoke about this on the last podcast. I'm the kind of guy that I always like. You're too. You like to have something to look forward to.
Yeah.
Right?
Yeah.
Like whether it's a vacation coming up or a tasty meal or, like hanging out with friends, whatever it is, like something fun and like you're looking forward to.
Or going to a cottage.
Or going to your new cottage. Yeah.
Yeah.
Which will fall in price. But right now, the economy doesn't really have anything to look forward to.
Right.
Right? So let's look forward right
Yeah.
now. Okay. We see interest rates are going to rise more. The asset prices are going to fall. People are going to feel poor. People are going to feel the pinch. Spending will cease. Asset prices down. Commodity prices down. People will spend less. Unemployment will rise. Then the central banks will pivot. They'll start dropping interest rates. We're probably going to see some type of, I don't know, like what do they call it? Modern monetary policy theory, where like they start writing checks to people.
Right.
So
Again.
yeah, money back in people's hands. Let's print some more money. Let's get the economy firing again. Let's drop interest rates back up again. Maybe a kind of longer road to inflation again, and then a worse drop than this one.
Like a worse drop in the economy.
Yeah. So like,
I mean, that's not looking forward to anything. That's terrible.
well, you got that little up. You get that little up in it. Like, okay, so there's another really kind of the scary part about all this is like, look, if you look at history, I think it was Plato that said that in the like when you create these very difficult times, because this isn't the first time that this has happened,
Right.
where an empire has tried to maintain its control and power over its systems by increasing the money supply.
Nazi Germany.
Okay, before Nazi Germany, the Chinese, like whatever the dynasty was.
Right. The Ming Dynasty?
The which?
The Ming Dynasty?
I don't know if it was the Ming. Maybe Matt can look it up.
Matt probably knows already. Matt's like, oh, yes.
Yeah, it was the Qin dynasty.
No, I did. I don't know a lot of Asian finance history.
Okay.
Sorry.
Anyways, it happened in Chinese history. It happened with the Roman Empire.
Mhm.
I'm sure it happened in other instances. It happened with Germany. But what typically occurs is a loss of democracy.
Right.
So like the ultimate fear is that a kind of strong, like look at South America. Like almost every South American country went through a period of extremely dramatic rising inflationary. Look at certain African countries, right? And the result has always been a loss of democracy. People will relinquish their freedoms in order to stabilize, and they'll put their faith and their trust in a strong man, a leader.
Or woman.
Yeah, I mean, yes. And in the hopes that things will fix, but they don't fix, right? Like that's a recipe for disaster. So I think like a lot of people right now are almost looking at that as what could come of it. That being said, that didn't happen in Japan.
Right.
Japan is, probably 15 years ahead of us in this period of like rapidly printing money to sustain their economy.
Right.
And they've lived through this now for much longer than we have.
Greece?
No. Greece is kind of, Greece is a much smaller impact on the global scale.
Right.
And because Greece is a part of the European Union, the European Union, namely Germany, was able to kind of absorb a lot of the missteps
Right.
of the country. Now Greece, I mean, like, is actually going through like quite a boom.
Right.
Hotels are popping up everywhere. There's large scale real estate development happening for now. For now. And so I think like the thing you have to be aware of right now is that all of this is going to happen in cycles.
Right.
And as bad as it's going to get, the Federal Reserve and the central banks around the world have these magical little tools to re-stimulate the economy.
Right.
But eventually, the one magical little tool, which they all kind of, they all kind of feed into, is that they're creating more money.
Right.
There's more money supply happening. There's more creation of dollars. And eventually that has proven historically to end badly. I mean, if you were a real conspiracy theorist, you would say that like
Matt.
the perfect storm, the kind of perfect storm was introduced when, a virus was brought into the world at a time when the economy was already in not great shape, right? Like if you rewind back to January of 2020, we weren't talking about a Canadian or an American economy that was doing amazing.
Right.
We were talking about dropping interest rates.
Yeah.
We were
rates were already cheap.
Yeah, it was like, the overnight rate was cheap. We didn't have much lower to go. I think we were at like 1% or maybe 1.25%.
The prime rate was, I can't remember.
Yeah,
3.7, I think.
Okay, I mean, we can look it up and pop it up on the screen, maybe, Matt. But we weren't in a great, strong position.
Right.
And then COVID came in, and we were like, oh my God, rates are low. Yeah, what's up, Matt?
Can I jump in? So honestly, I have public Facebook posts going back to like 2017 where I was saying that all we needed was a catalyst. Like the economy was on some teetering edge, and I said it was either going to be a war or a terrorist attack, but a virus. It was and I'm not a big conspiracy theorist. I'm not. I just know I'm not though. And I just know a lot of history, and I was publicly saying it that all we needed was type of a catalyst, and that's what it was. I said it 2021 or said 2020, 2021 were going to be bad years. In 2017, I was saying it that we just needed something to push us over the edge there. And you know what? I will also jump in for historically for people that don't know this idea of rising interest rates to fight inflation comes from I believe it's Keynes economics, where after the Great Depression, instead of interest rates, it was taxes, and the government raised taxes. And then through the 30s, companies couldn't expand and hire because taxes were too high. So Keynes actually introduced the idea that if we lower taxes, companies can expand and build. And that's where, the workers' unions came in and triggered the 1937 recession. But from the Great Depression on, because of Keynes economics of rising interest rates to fight inflation, we've gone through 15 bear markets or 24 bear markets and 15 recessions in the last 100 years. But we've never gone through another depression because of this, modern monetary policy, these ideas. But we'll see if it works this time. A lot of time, people have been saying it's just the can being kicked down the road for another 100 years. Right. So if people don't want to learn more, you can read a great book called The Big Three of Economics. It teaches you about the biggest three creators of the systems that we have.
That's good. So, what I was trying to get to was we were already on a weak economic footing.
Right.
COVID comes in. And it was like the first hit, right?
Right.
And it forces the G7 nations to overstimulate as quickly as possible. You remember this?
Mm-hmm.
Doesn't matter how we do it. Let's just get money out into the system as quickly as possible. Let's get it into people's hands. We got to save this economy. We got to save people. Don't worry about where the money goes. And we were saying on this podcast, it'd be really nice if we took a little bit of a pause and tried to figure out how we could get the money into things that would create value for our country and the world into the
Right.
future. Sustainable energy, technology, creating
Training,
kind of
yeah.
growth industries, education. Because you can spend money anywhere and stimulate the economy. You might as well spend it in the right places.
Right.
We didn't do that. We just literally fired checks out to people.
Right.
Doesn't matter who you are, doesn't matter what, just take a check, get some money, spend it. And that created this economic boom while everyone was kind of locked in their basements. And then, as we're coming out of it, there's a war, which increases a lot of the input prices for commodities, right?
Mhm.
These two economic events lead to this massive inflation.
Mhm.
And that inflation destabilizes countries. And rapid, dramatic inflation destabilizes them more. So the only action that the Federal Reserve and the central banks can take is to fight that inflation. It's what they know.
Right.
So now they're fighting that inflation.
Right.
But the fight of fighting that inflation is going to lead to a recession.
Right.
Just how bad is the recession going to be? How bad the recession is going to be is only going to be dictated by when we're going to stop raising interest rates.
Mm-hmm.
At what point do they come off? Do they take their foot off the brakes and say, "Okay, we got to do something to re-stimulate this economy"?
Right. The longer they keep their foot on the gas
Brakes.
of rising, rising interest rates.
I know, but just the brakes, right? Like
No, but
raising
if
interest rates.
If your foot's aren't on the, if your foot isn't on the brakes, where is it?
If you're driving the economy, increasing interest rates is the brakes. Putting
Okay,
your foot on the
so
gas
sorry.
is decreasing interest
Right.
rates.
Okay. So then, the longer they keep their foot on the brakes
Mhm.
by rising interest rates, the less, the better off we're going to be down the line, is what you're saying.
Yeah, I guess
Because you were mentioning like after
long term.
Yeah.
I don't know. I mean, who knows what the next kind of variable that we'll have to contend with is.
The
But
next
I can
corona.
tell you that the longer we keep our foot on the brakes, the longer interest rates continue to rise, the more dramatic, the more of these big rate hikes we see, the worse the recession that we're going into is going to be. Like, it's not the time to buy real estate right now.
Right.
And I think we'll know the full impact of how bad it's going to be in the spring market.
Right.
Because people don't know, right? Like, how can you make a knowledgeable and informed decision on buying something right now when you don't know when the rate hikes are going to stop?
Right.
Right? I mean, I think that you'll see people will re-enter the market when the central bankers say, you know what, this is it. Like, we've
We're
seen
done.
inflation's abated. We are going to, we're no longer rising rates. We're comfortable where they are right now. And then whatever that language in that monetary policy meeting is, whether it's probably the Federal Reserve, and then afterwards the Bank of Canada.
Right. And we think that might be 2024. That's our guess.
No. I think for sure in 2023 rates are going to stop
Right,
going up.
right,
I think
right,
at this Q1 of 2023, there's going to be no more rising interest rates.
Right.
And I think Q1 of 2023, Q2 of 2023, hopefully the markets respond favorably to that.
Right.
But right now, last show I was telling you that I was buying puts on
Yeah.
the S&P.
Yeah.
And last show, I got a whole bunch of people reach out to me and to the show who were like, this guy's crazy. He's buying 380, 360 puts on the S&P. Because the S&P, when we did our last show, was at like 4,200.
Right.
Well, now the S&P's at 3,800.
Right.
Puts are in the money. So, I mean, listen, I'm not the ultimate stock market prognosticator by any means. I just, on a macroeconomic level, we're increasing interest rates so quickly and with such kind of deliberate and focused resolve for fear of this inflation, that we might be missing that maybe the environment is starting to become deflationary.
Right.
And the more we continue to attack inflation with higher interest rates, maybe the more of a problem we're creating for ourselves in the future. Right now.
Right.
Right. The market is like, listen, the other thing is it's a balancing act, right?
Mhm.
And it's hindsight's 2020.
Yeah.
So
It
when we're
definitely is.
out of this, which is going to happen, right? Like
Mhm.
it's never as good as you think it is. It's never as bad as you think it is.
Right.
But the inflationary fear is real for central bankers and for politicians. So I think, I think if I was in the market right now for refinancing my house, or for if I needed extra capital, or if I was looking to buy something, I think no move is the right move right now. I think
Right.
like if you need money, let's assess the weighted average cost of capital, figure out whether it makes more sense for you to take a second mortgage and leave your existing first mortgage in place, or if it makes sense for you to take a variable rate right now.
Right.
Understanding that we're probably going to see another 100 basis points, not all in one shot, but another 100 basis points increase. But locking into a fixed rate right now is not a good idea, because within the next 12 months, interest rates will start coming down again.
Right.
They cannot just continue to increase. I was speaking to a trader the other day, like a food trader,
Mhm.
who kind of like buys and sells future contracts on steaks, or like beef or pork.
My stepdad does that for pork.
There you go. And he was saying he's already year over year from last year, things are now lower.
Right.
Like lumber prices are off 60% off the peak, right? Commodity prices are going down
Yeah.
for the most part.
Yeah.
And
My grocery bill yesterday was outrageous.
yeah, but your grocery bill's always outrageous.
No, but this is for the same things I always buy.
Right.
And I checked my mortgage statement,
Mhm.
and I'm at a 60-year amortization right now.
Oh, because you're
Yeah,
on a
I haven't been paying attention.
right.
Yeah.
Yeah.
60 years.
Yeah. I mean, I think that's okay for now.
Yeah, it's fine.
It's interest only, basically.
Be sure to
Yeah.
visit makemoneycount.com to find all of our old episodes.
That was a good talk. I really liked that. I do have some questions from our loyal viewers
Mhm.
that I wanted to fire off, if you don't mind.
Shoot.
Okay. So I got one here. What's funny?
I don't know why. I find you so amusing sometimes.
I'm an amusing guy. Okay. All right. Hey, Justin and Marcus. I was hoping you could give me some investment advice other than puts on the S&P. No, I'm kidding. It doesn't say that. I've been seeing on the news how unstable the market is becoming and how the prices of homes are dropping. And I'm starting to wonder if investing in real estate is still necessarily low risk. According to your website, your MIC returns have been stable and consistent. Do you see that going forward in this environment? That's a good question.
Yeah, I mean, MIC returns have been going up. It's simple, right? Okay, so the way the MIC operates is we try to plan for events that are occurring in the market.
Yeah, like we're prepped for this.
Yeah,
Let's just preface this what a MIC is, a mortgage investment corporation, for those of you who do not know.
right. So we have a mortgage investment corporation, which is an entity described by the Canada Revenue Agency as a fund that aggregates people's investments, whether it's through an RSP or a TFSA or a retirement savings vehicle, and we pull all of this money together, and we invest it into different mortgages.
Right.
And then as long as all of the interest that we're accumulating from the mortgages that we're investing in goes out to our investors, we pay no tax.
Right.
So it's pretty simple, right? Pick good mortgages, invest in good mortgages, good people, and then take the interest and funnel it to your investors. We take a 2% management fee to do that. Because of how fearful I was of these rising interest rates, we were sitting on a large amount of cash and a large number of first mortgages, not second mortgages.
Mhm.
And as you know, as you know, and as Matt knows, and if you followed along, the average loan to value of our fund is about 50%. So we're quite risk averse. If you are a borrower with Connect, you'll know that we can only really use our fund to help borrowers who are kind of slightly off the mark of a bank or of an exit, because the whole premise that we've built Connect on is that we're using our investors' capital to fix something that's deficient in an application,
Mhm.
right? Someone's fixing real estate, someone's fixing their credit, someone's fixing their income, something's getting fixed. And we're going to help you fix it. We're going to give you the money that you need to fix it.
Mhm.
And then we're going to help you get into lower cost capital. That's how Connect works.
Mhm.
Because of the way we're structured and because of, how we're kind of looking at the market on a constant basis, we were in a very defensive position going into these rate hikes. So it allows us to now use some of that capital. And as some of these mortgages that we've got mature and those borrowers go to lower cost capital, albeit not as low as we had initially assumed, because interest rates have risen so dramatically.
Mhm.
But because they are of a high quality borrower and real estate, the money still comes back, right?
Mhm.
It might take a little longer on certain deals for us to exit them into the product we need to exit them into. Sometimes people might not get into the rate that we had initially anticipated they were going to get into, but the money still comes back.
Mhm.
And now as the money comes back, we're still redeploying that capital.
Mhm.
But because there's fewer players in the market, right? Like you see this now, you source mortgages and you send them out into the market, right? Along
Mhm.
with our underwriting team.
Mhm.
Well, when you're sending it out into the market now, there are fewer participants in the market
Mhm.
because a lot of our peers, a lot of our competitors overlent on real estate. So I remember, right? Look, we saw people lending up to 95% of the value of a home
It's crazy.
1 year ago.
Yeah.
Well, if you lent 95% of the value of the home, cost somebody 5% to sell their home. And if the property value drops, as it is currently dropping 20%, well, then it is very difficult to get all of the money that you've lent to the consumer out. It's not good for you. It's not good for the consumer.
Mhm.
What that resulted in is a lot of mortgage investment funds and private mortgage lenders are no longer participating in the market.
Mhm.
And as a result, consumers have fewer places to go.
Mhm.
And interest rates have risen.
Mhm.
So the MIC as an investment vehicle is able to create a very healthy return for its investors while still servicing the right borrowers.
Right.
So it's been good for our mortgage fund.
Mhm.
It's just not. It's what is not good for the consumer is not good for the industry. Like long term, you can't and that's how Connect was created, right?
Right.
You
Yeah,
can't look at, oh wow, companies doing great because we are making more interest margin on deals and there's fewer competitors out in the market. That is not a good thing.
yeah. Right.
It's not healthy for the marketplace. We need competition in the marketplace. We need more market entrants. We need more options for our consumers. Eventually, if the market kind of seizes up, which is what's going to happen, credit markets will seize with these rising interest rates. Asset prices fall, credit becomes harder to come by. Once that credit becomes harder to come by, asset prices fall more, people can't borrow. That's bad for the consumer. It's bad for the industry.
Right.
Um, but because we operate a relatively small fund, we can kind of contain our exposure. We contain our exposure very well in the market.
Yeah.
And we're able to spit off a return which is, kind of been close to 9% this last little while.
Mhm.
And that's a factor of we've got interest rates rising and we're not trying to shoot the lights out, right?
Yeah,
We don't
yeah,
take
yeah.
undue risk with the capital.
Yeah.
There's a couple of reasons for that, right?
Yeah.
Number one, I have my entire family is in the fund, including me. And you. Yeah. And Matt. And everyone that works at Connect.
Everybody.
So we don't take undue risk with the capital, and we use the capital to help the borrower.
Right.
And that creates what we talk about, that motivational alignment,
Mm-hmm.
that alignment with the borrower, where we're working in partnership. We're using the money from our investors to help our borrowers get to lower cost capital and then return the capital back to us. That's not going to change.
Mm-hmm.
Like, that still happens on a daily basis. It's just in the market that we're in right now, there's fewer people vying for the attention of that borrower.
Right.
So listen, what do you do in this market? What do you invest in? Sometimes the best investment is no investment.
Right.
And although it's scary that there's this inflationary pressure, and this inflationary pressure would cause one to think that keeping cash on hand is a bad idea. Actually, I listened to an interview with Charlie Munger, who is like kind of Warren Buffett's partner at Berkshire Hathaway. He's 96 years old.
This not Warren Buffett.
Charlie Munger. I
Right.
know what,
Warren
what
Buffett's
was it, like
ancient too.
95.
Yeah.
He's the spring chicken out of the duo. And he said,
Spring chicken.
he said historically, Berkshire Hathaway does, like, although Berkshire Hathaway is currently sitting on a large pile of cash, he's like, we're not hoping to sit on a large pile of cash. We are kind of always looking to deploy cash. We just need the right pricing.
Right.
So although he's not kind of specifically out with the motivation of accumulating cash and holding it, his is more focused on when he can identify an opportunity to deploy the capital. We're seeing people hold cash.
Right.
Because, again, making no move is sometimes better than making a move.
Right.
I would like the other thing he says actually is he's like this theory of diversifying a portfolio. So you need to have 20 different asset types in your portfolio. You got to have tech, you got to have real estate,
Mm-hmm.
you got to have fixed income, multiple asset classes, so that your portfolio is, has good exposure to the marketplace. He's like, it's stupid.
Right.
He's like, I don't have this level of exposure. I'm not smart enough. This is a guy who runs a multi-billion-dollar fund. He says, I'm not smart enough. He's like, I think I might have 4.
Mm-hmm.
I have some apartment buildings. I've got some holdings in some companies that I really believe in. But apart from that, I'm not smart enough to go out and analyze all of these different asset classes to fully diversify my portfolio.
Right.
And even Warren Buffett echoes that in an inflationary environment, you should invest. You should invest in yourself.
Right.
You should invest in upgrading your skills. Again, we talked about this, like investing in education, investing in upgrading your kind of suite of tools is never a bad idea. So
Gary Vee says the same thing.
great. I didn't even know who Gary Vee is. You always recommend him. It's like,
You don't know who Gary Vee is?
no.
He's one of the
He's basically like a tiny Tony Robbins. Right?
So
Sorry, Gary.
no, so Gary Vee's
Tiny little Gary Vee.
in the late 90s, he took over his father's liquor store in New Jersey and started up a wine business online called Wine Library. And he was selling more wine than the state of California within a few years. So from there, he just expanded his investments into other online businesses. Like he was an angel investor in Uber, Twitter, a bunch of other things. And he's worth quite a few billion now.
Can we please get a picture of Gary Vee up on the screen? Please?
I'll post a
Thank you.
picture of me and Gary Vee together.
We're trying to address the question of what this person should invest in.
Right. Well, no, I mean, the question was 2-part: is the mix stable, and what should I invest in?
Yeah, listen, I mean, if I would always suggest investing in our mortgage product. Like, it's really well managed. We got so many great people involved in it.
I had a great conversation with somebody yesterday. They came into our office at Navy Wharf, and he actually wanted to be a mortgage agent.
Mhm.
So he wanted to be a mortgage agent, but he didn't want to do it full time. And I kind of had mentioned that like our team is very full time. Like we're dedicated to our clients. We're always in the office, stuff like that. And he also mentioned that he had some cash, and they told him about the MIC. And his first question was like, "Well, obviously, things aren't doing too well right now, right?" And I was like, "What do you mean? They're doing better than ever." You know what I mean? So the question of are things stable is yes. You know what I mean? Like we're
Yeah, it's all in how you lend, right?
yeah, exactly.
It's all in how you lend. If you're trying to go for outsized returns, it is best to do it when you are overly confident that the asset prices are increasing.
Right.
And like any cycle, asset prices can't increase forever.
Right.
And if you play defensively and for a long term, you're going to win.
Yeah, the tortoise.
The tortoise.
The tortoise always wins.
What other questions you got for me there?
I do.
Tortissimo.
Let's see here. Tiny little Gary V. Okay.
The tortoise.
I have heard that buying. Okay, this is another question. I have heard that buying a rental property is a good investment. You kind of touched on this. Do you still think that is the case with rising interest rates and real estate prices falling, or should I hold off now on, or should I hold off on this decision for now? I mean, you already said hold off,
I mean,
right?
I would hold off. I don't know where the rental property is. I don't know how great of a deal they're going to get on it.
There's a lot of variables.
Yeah. Listen.
Rental rates are very high right now. Like you know what I mean?
Yeah, but you know why rental rates are high?
Because interest rates are high.
Because people are afraid to pull the trigger on purchasing because they
Right.
don't know how much higher interest rates are going to go.
Right.
But when interest rates stabilize, people will then migrate out of rentals back into purchasing. Like, listen, it's a cycle.
Right.
We're in a cycle. We're just in
The pendulum.
a dark
is-
period. Yeah. Like,
The return to the means.
yeah, return to the mean. Listen, every single night,
Return to the Gary V.
every single night, it gets dark.
Right.
Are you terrified? Not anymore. Like, not ever since Kelsey started holding your hand when you fall asleep.
Yeah.
Every single night it gets dark, and every morning it gets sunny again.
Right.
And you are able to cope with it.
Yeah.
Right?
Yeah.
Still you.
I feel like I should be lying on one of those leather, like not a chair, but not a bed.
Mhm.
You know what I mean? And you should have a clipboard.
Taking notes.
Yeah.
But like, think about it, right? Every night it gets dark. Every morning it gets sunny again.
Yeah.
You don't need to knee-jerk react, right?
Right.
Asset prices got really, really frothy and really, really rich. Made people feel really, really rich. Made people spend lots and lots of money. Now asset prices are coming down. People aren't going to spend so much money. If you were to approach asset prices the same way that you approach the rise and the set of the sun, maybe you'd be in better shape. And you are in good shape. I'm not saying that. I'm just saying, generally speaking, it's never as good as you think it is. It's never as bad as you think it is.
Right.
Although it's probably going to get pretty bad. It'll get good again.
I feel inspired right now. I feel very inspired. That was inspiring.
Good. Any more questions for me? Or
I have one more.
Sure.
It's long.
Okay.
Whoever wrote this wrote quite a long email, but that's okay. We're going to read it. All right. Are you ready? Hey guys, I'm in a pretty tough spot and could really use some advice. We should start reading these questions in the beginning of the podcast because generally by the end of the podcast, we answer all the questions that these people had, but I'm going to read it. Hey guys, I'm in a pretty tough spot and could really use some advice. My house desperately needs renovation and I don't want to take out the money I have in investments to fund it. This person's probably invested in a firm. I've seen how much interest rates have risen in the past few months and how the value of homes has declined. I think I want to take advantage of the equity I have in my home before values drop too much, but I don't want to be stuck with crazy high interest rates and a high payment. I really don't want to be confined to a term considering I don't know how long the renos will take to complete. I have a low first mortgage, so I know there has to be options for me. What do you recommend?
Okay. We have to glean what we can from the information we've got in this long email. So
So in the future, if you're writing us an email,
Give
you
us
have
some
a
rates.
question, give us some rates, give us some
Yeah.
amount, juicy details that we can bite into.
But we'll take some assumptions.
Yeah, let's assume.
So $1 million house.
Assuming never made an asset of anybody.
You're on today, huh?
I'm on fire.
For you, on.
Yeah.
Let's say it's $1 million house.
'Kay.
Low mortgage is what? 200 grand.
250.
Reno's going to cost what? The same amount.
200 grand.
All right. So then, and they got a low fixed rate first. I would say kind of first option would be to weigh, and obviously we need to speak to them to get our teeth into this deal to figure out what the best route is. But I would look at the following. I would look, number one, at a line of credit.
Mm-hmm.
Second position line of credit at prime or prime plus a half, depending on where you go. Second option, redo the entire first with a new variable rate mortgage.
Mm-hmm.
I know it sounds crazy because rates are so much higher. We don't know what the fixed rate is, but you can easily weigh the cost of breaking the existing fixed and the cost of the increase from the fixed to the new variable against the cost of supplementing the existing first with the line of credit. Because the new variable will be prime -1, line of credit is going to be prime plus a half. If it's $200,000 that we're talking about as a differential, that's a 1.5% spread on that 200 grand. So rough numbers, if you're only increasing if you're increasing the rate of the first mortgage by less than 1.5%, it might make sense. Right?
Right. I mean, I think so.
Less than 75 basis points.
I feel like I need an abacus on this show.
Anyways, these are your options, right?
Right.
And then if you don't qualify, then you're looking at second mortgage or a home equity loan. That's when you have to start deciding how badly you need to do the renovations.
Right.
I also think we're heading into a period of time where renovations are going to be cheaper, right? We mentioned earlier, lumber prices are coming down.
Right.
Fewer people are going to be working on their homes. Home Depot's stock's going to fall. Lowe's stock's going to fall. People aren't going to be doing the renos that you saw them doing over the last 2 years. Money isn't cheap anymore. Their house prices aren't appreciating anymore. The value that they will extract from making those renovations is no longer as certain as it once was. As a result, fewer contractors. You know what that means? Fewer pickup trucks on the road.
Right.
Anyways, but you're going to see less home improvement happening, which means home improvement will become cheaper.
Right.
Might not be at that point yet, but that's where we're going. So it will be cheaper to do the things that you want to your house. You're going to have to weigh that as one of the variables, right?
Right.
So, and we'll help you with this, right?
Mm-hmm.
But I would just say before you look, like I never, like, it depends on how badly you really need this renovation. But if you can do it with minimal increase to your borrowing costs, go for it.
Mm-hmm.
But if you're looking at like a second mortgage or a home equity loan to do it, especially in this environment, let's take a deeper look at it.
Yeah. Is it worth it?
Yeah.
Yeah.
Because like the time is, we're heading into an uncertain period.
Mm-hmm. Well, I mean, listen, like we always say, the best way to figure out what the best options are for your home or your home's equity gives a show.
I mean, the other thing you can do is you can go online to connect.ca.
Right.
You can just enter in your address and we will pull all of the information and we will provide you with all of the options available to you for the amount of money you're looking to borrow.
Right.
It's really simple. Like we tried to cram all of the knowledge and the unbiased advice and the way that we operate when you phone us, which can be daunting, right? Like picking up the phone and calling somebody and going through all these details, pain.
Right.
You can go online, you can enter in these details, your address, your name, your email address, and we'll send you a report of what we think, how you can best borrow money using your home and what the various prices are.
Mm-hmm.
And then you can give us a call.
Yeah.
It's all part of this kind of the way that I believe the internet works best, right? It's a trust relationship game,
Mm-hmm.
right? If you have a website on the internet, I've always firmly believed this. If you have a website on the internet, it should be like your office, right? Should look nice. People should want to come in. And when they come in, they should get something.
Right.
They should get value, or else they're never going to come back in your office again.
Right.
So
agree.
Connect's value, the way Connect shows value is when you come to our website, you give us your address, and we're going to show you how smart we are.
Right.
We're going to show you the best rates on the market, how you can get equity using your home, what your house is worth, what the mortgage you got registered on it is, who you are, and we'll spit it right back at you.
Right.
At that point, if you want to do business with us, amazing.
Right.
We think you're going to want to, but you might not want to. At that point, that's when we get on a phone call, meet with you in person in one of our offices, and we start really looking at those options.
Mm-hmm.
Figuring, like, it's hard to judge time horizon
Mm-hmm.
for somebody that's filling out a form online. You can ask them the question, and we do ask the question, but it's such a critical part of borrowing money that you really need to get your hands on that. You really need to kind of assess that with the borrower.
Right.
So I can't recommend this enough, right? If you're watching this and you're wondering, okay, like, I'm still uncertain as to how this affects me. I do need some money right now, or I would like to refinance my mortgage, or my mortgage is coming up for renewal. Oh my God, what a bad time for your mortgage to be coming up for renewal. What do I do? You can start off by just going to the website and filling in your address, and it'll provide you with your options.
Right.
And then if you like those options, which I think you will, give us a shout, or we'll phone you, and we can spend 15 minutes on the phone.
Yeah. Hopefully, before Marcus goes globetrotting again, he'll be here with us again in the studio.
Yeah.
He will be.
Yeah.
How long are you here for?
I don't know.
All right. Well, that was it for this week. We will see you next week.
Thanks, guys. Good insight today, Matt.
Thank
Yeah.
you. Ciao.
Bye.
Arrivederci.